Hello, welcome to the class 2506 funding call. So today, what we're going to do, we're going to dive in, look at the hill that we're climbing together to see kind of where we've been, what's coming up, where we're going. We'll look at the leaderboard, see where folks are in the mix, and then we're going to get into some really good stuff around financing, which I can tell you from experience is usually the biggest hurdle for a lot of folks as to why they don't end up making a decision. And I think what you'll learn today is definitely going to help ease concerns and at least help you know that you're going to make the most educated decision that you possibly can. We'll look at different financing options, entity selection and formation, which, by the way, I think is one of the most overstressed pieces of starting a business. Because you really want to find out the financing first before you make an entity selection, because sometimes financing dictates entity selection. And the whole point of our process is to do stuff in order so that you don't end up making a mistake and having to go back and redo stuff. We'll talk a little bit about tax strategy, the unit economics of some of the franchises. I know some of you are already starting talks or at least have them scheduled with franchisors coming up. So that'll help you kind of get the most out of that unit economics call. And then outsourcing all the things that aren't your core competency, we'll cover that. And as always, with questions and answers, if you guys have them as we're going through, throw them into the chat, or if it's appropriate, you can throw them out there and we'll either answer them as they happen or at the end. And then at the end, per the usual, we'll go to the breakout sessions with your respective coach to get some more in-depth info and see if there's anything you guys wanted to share or ask amongst the veteran group that's in there. So, all right. There's the hill. So you can see we're about halfway up. Today we're going to be looking at funding, and to look at where we came from and where we've gotten to is really quite significant. Even, taking the steps to go through this process to work with us through a discovery call to see the options available, to evaluate them. A lot of you have already gone through the options call and made that selection and chose a franchise or two, or maybe at most three, to kind of get registered with and to dive in and ask questions of and start that franchisor call. From the franchisor perspective, they're going to go through unit economics and talk to you about the breakdown of the cost of that franchise. When you meet with your coach, we're going to go through funding options. And when you know the total amount of that investment or a range, that's when it's appropriate to go and start looking at different funding options. Is SBA the right thing? Do you want to use retirement funds? And, for instance, if SBA is the route you want to go, we need to start sooner than later to start getting a pre-qualification to make sure that that's something that you can do and that there aren't any hurdles to that. For the later steps down the road. The next part that's going to come up after this is going to be reviewing the disclosure document. If you probably haven't received that yet at this point in the process, you may or may not have seen one of those before. They're intimidating documents, but a lot of really good info that you do need to read. And after reviewing that, and the best part, in my opinion, is doing validation and throwing all this information past other owners, having them share as much financial information as they can to help you make a good decision about the franchise and see how they ran it. Did they get an SBA loan? How did they finance the franchise? And really see how they're running it, to see if they have lessons learned or things they would have done differently had they known X, Y, or Z. So that's a great part of the process, which is followed up with an invitation to a confirmation day and possibly getting awarded a franchise and then becoming a Vetrepreneur. So that's the hill. It's always good to turn around and look and see what you just climbed up. So next slide. All right, class 2506, 21 strong. You can see a lot of folks still in step 4. This may not have been, there's step 4 calls the last couple of days, so there may be some that need to get updated on there that are now in the franchisor calls. That's about the step you want to be in, having that first or second call with the franchisor, really seeing, how it's run, what the breakdown of that cost is, and kind of making progress with them to see if it's a good option for you or not. And then we've got Billy out there working with his franchise and still doing a lot of good due diligence and vetting along the way. All right, and now I have the distinct honor to hand off to the expert, Mr. Michael Reeder, who is the owner of Reeder CPA Group, which has been a very respected business partner with Vetrepreneur that really has done a great job helping the veterans that we've sent his way to help you guys make an informed decision. Being able to kind of hear the information from the expert in order, and having a strategic CPA can't be emphasized enough. It definitely helps you take advantage of the tax breaks that are out there for small business and helps you really make the most out of the bottom line of anything that you do. So without further ado, I will hand it over to Mr. Michael Reeder.
Thank you, Doug. I really appreciate the kind words, and it's great to be with you all today. Happy Friday. And what can I say? I wake up every day with the opportunity to serve veterans. So I'm feeling blessed. And so great to be with you all. So let's get into it, shall we? So as Doug mentioned, I'll recap it real fast. So my name is Michael Reeder. I see some familiar names on here that we've already had one-to-ones. So like Thessalonian, it's great to see you, buddy, and some others. And so I'm the owner of Reeder CPA Group. And so we're a CPA firm for small businesses. We work with a lot of franchise businesses. We're a virtual national CPA firm. We have clients all across the country. Our team is all across the country as well, all stateside. We have physical locations in the Chicago area and the Maine area. And so over the last 11 years, I've developed a process working with franchise professionals such as the Vetrepreneur coaches to be a CPA resource for franchise buyers such as you all, prospective franchise buyers such as you all, to answer any questions that you have as you're going through the process that you're going through right now with Vetrepreneur. Any questions in the context of entity structure strategy, funding strategy, tax strategy for small business ownership. So regardless of it being busy season or not in my industry with tax deadlines, there's peaks and valleys with deadlines, but what I'm doing consistently throughout the year is having conversations just like this, diving into entity structure and funding strategy with new business owners. And so funding, financing, two different terms for the same thing. So that brings us into this first slide here. So financing your franchise. There's 6 bullet points here, and so a lot of them, so what's important to understand is when the word leverage, right? So leverage in this context means what are you doing in terms of like taking out a loan, right? A loan to fund your franchise investment. So SBA loan, HELOC, right? Home equity line of credit, 401k or TSP loan, and then family or friends loan. What those four that are on the slide right here, what those four have in common is that they're all different types of leverage strategies, right? You're leveraging either a third-party loan, like an SBA loan, or you're leveraging a personal asset, like a home equity line, in order to fund your business. That's a common funding option. And then you'll see ROBS. ROBS is an acronym for rollover as business startup. So that's a unique entity structure funding combo that is a way for you to use your retirement money that doesn't have the limitations like a 401k loan does, and we can get into the weeds. If we don't get into the weeds on anything here, we'll definitely get into the weeds on our one-on-one calls. But a ROBS is a way for you to use your retirement assets to fund your business, and if you do a ROBS, then it's mandated that you have to structure your business as a C corporation. And then there's good old-fashioned cash, right? Do you use your cash, or do you have your non-retirement brokerage accounts that you can get a pledged asset line of credit against those, so you can leverage your cash and cash equivalents instead of using your cash. So you have different options there. And so a seventh bullet point, Doug and Sherry, that I've found myself talking a lot about over the last month or so, that I think it's beneficial to bring up here, is a seventh bullet point to always look into while you're going through the process, is what, as I like to refer to as, what low-hanging fruit is available to you in the context of municipal, county, and state programs. There might be some various loan and grant programs that are available at the municipal, county, and state level, whatever municipality you're in, whatever county you're in, and then whatever state you're in. SBA is federal, right? And so municipal, county, and state, there might just be, in your respective municipality, there might just be like a random, if you're a new business in this county or in this, town, village, or et cetera, you qualify for a $15,000 loan or grant, right? And then there might be specific to what industry you're in. It might be specific if you're, if it's a certified veteran-owned business and or certified minority-owned business and or certified women-owned business. So just always explore that stuff at the municipal, county, and state level. Low-hanging fruit if it's there, and then there might be nothing, there might be something, and so and so it's worth looking into, because the worst answer is no. And so but these are all different examples of funding or financing your business, and so what we do is we dive deep into all of these financing strategies, and we come at them from the angle of strategic tax planning. So choosing the right entity and formation. So we just talked about financing, and financing, aka funding. I use those two terms interchangeably, so I just want to over communicate. Financing your business or funding your business are two different ways of saying the same thing. So choosing the right entity and formation. So pretty much on the free CPA consultation calls, that we have with veterans, we dive into entity structure strategy, which is this slide, and the financing strategy, which was the previous slide. And we come at those two things from the angle of strategic tax planning. And so the different entity types, we talked about the different funding options. And now, so the different entity types are what's here on the left side of the slide, right? So are you going to structure as an LLC or a corporation? And then is your entity structure going to be taxed as a sole proprietorship or a partnership or an S corporation or a C corporation, right? So LLC, liability, flexible taxation. So a limited liability company, an LLC, is what's known, so it is a legal structure that you form at the Secretary of State level. And then an LLC with one owner by default is taxed as a sole proprietorship. An LLC with two or more owners by default is taxed as a partnership. And at any time, either at inception or a little bit down the road, the LLC can elect to be taxed as an S corporation or a C corporation. An S corporation it could be an LLC taxed as an S corporation, or it can just be a regular corporation taxed as an S corporation. S corporation, the primary strategy of going S corporation from a tax saving perspective is to save money in Social Security and Medicare taxes year over year. And so we dive into that a lot. It makes sense for a lot of small business owners to be taxed, whether you're structured at the Secretary of State level as an LLC or a corporation. It makes sense for a lot of small businesses to be taxed as an S corporation for the purpose of mitigating the amount of Social Security and Medicare taxes that you pay year over year as a small business. And a C corporation, the most common place where you're going to see a C corporation is if you decide to go the ROBS route, right? Rollover as business startup, as we talked about in the previous slide. If you go ROBS, if you use a retirement rollover business startup as your strategy, you're going to have to be a C corporation. And a C corporation pays its own tax. It's separate, and it doesn't flow through to the personal return like a sole proprietorship, partnership, S corporation tax classification does. A C corporation is by itself. It's the, we all hear, like when you hear in the news, the corporate rate's at 21%, and all that stuff is referring to C corp tax rates. And so you have to be. There are some times when being just a non-ROBS C corporation makes sense. And again, we can for anyone interested, we can rabbit hole into that in the breakout rooms or on our one-on-ones. But most of the time when you see C corp, as you're going through the entity setup and funding process, it's going to be in the context of, because you're doing a ROBS, therefore you're forced to be a C corporation. And then regardless of LLC or corporation, regardless if you're taxed as a sole proprietorship, partnership, S corp, or C corporation, once your entity is set up, then you have to, on the right side, the formation steps that you see on the slide, on the right, registering with the state, that's always step one, right, with the Secretary of State. And then you get the tax, the EIN, acronym for Employer Identification Number. You get the EIN number with the IRS, right, the federal IRS, and then setting up business licenses and accounts, registering your entity with the applicable taxing agencies for payroll taxes, sales taxes, getting a resale certificate, miscellaneous state and local business taxes, all of that stuff you would, take care of after you create the entity at the Secretary of State level and get the EIN number with the IRS.
Michael, do you see the question that came in from Tamara?
Yes, I did. Let's see. So Tamara asks, how does the number of employees impact the business structure? That's a great question, Tamara. I would say that the number of employees impact the business structure does not have as much of an impact as much as the profitability of the business. And so first of all, if you go ROBS, the business structure is C corporation. It's just, that's the end of that conversation, because it's a ROB, so it has to be a C corporation, and it's just going to always be a C corporation unless you were to, get out of the ROB structure, which is easier said than done. And so, regardless of how many employees you have, if you're a ROB, you have to be a C corporation. Now, if you're not a ROBS, if you're just a regular corporation, taxed as a C or an S, or you're an LLC, taxed as either a sole proprietorship, partnership, or S corp or C corp. What mainly determines how you're taxed is whether or not you're profitable or not. So if you're not profitable, then there's really no tax savings of being an S corporation. And so, starting out as a partnership or a sole proprietorship, for your LLC makes the most sense when you're starting out as a brand new startup business. You're ramping up. You're going to have a startup loss, which is expected. Then you're going to hit break even. Then you're going to be profitable. And then once you're at a profitability of around $40,000 or $50,000 of net income before owner's compensation and then above, that's when, so $40,000 or $50,000 before owner's compensation and higher, right? 40, 50K and higher of net income before owner's comp. That's when electing your entity, your LLC, to be taxed as an S corporation makes sense. And that's the case whether or not you have 1 employee or 10 employees. Is that helpful, Tamara? Alrighty, I'll just assume.
Yes, very much so. Thank you, Michael.
Got it. Thank you. And then is it Tamara or Tamara?
You had it correct. It's Tamara.
Awesome. Got it. Okie dokie. So here we are, crafting a winning tax strategy. So top left, key deductions for franchisees. So the primary thing that it is important to differentiate here is that it says, so startup costs, franchise fees, marketing expenses, deduct some things you're already paying for. So let's start up there. So startup costs, franchise fees. So it's important when you're going into a franchise, it's important to differentiate between the following 2 things: initial franchise fees and royalty expense, right? Initial franchise fee and royalty expense. Okay. So what this is referring to here is the franchise fees, which refers to the initial franchise fees. So if you're moving forward with franchisor XYZ and you're purchasing one territory and the total investment's $250,000, and of that, and you're going to do it with an SBA loan for the majority of the purchase and put 10 to 20% down, and then of that $200,000, $50,000 represents the initial franchise fee. That $50,000 franchise fee has to get treated as what's known as an intangible asset for tax write-off purposes, which means that you can't write it all off in one shot when you pay it, like you can a lot of other expenses. You have to capitalize it as an asset and then write it off over 15 years or 180 months. And and then if you sell the business before that, then the unamortized amount would add to your cost basis when you sell the business. But as it were, as a royalty, so the initial franchise fee is what you pay to the franchisor up front when you first sign up. That's the initial franchise fee. And then I mentioned how it gets reported for tax purposes, how it gets treated for tax write-off purposes, where the royalty is the monthly fee that you pay the franchisor ongoing, and the royalty is expensed fully as incurred, right? And so that's the difference between franchise fees and royalties. I see a lot of times, before they come to Reader Group, existing franchisees may toss around those two terms like they mean the same thing, or like one, they're talking about a royalty, but they're calling it a franchise fee, and vice versa. But it's important to differentiate between the two and how they're treated for tax reporting purposes. And then any startup expenses that are the fixed assets that are part of that initial investment, such as vehicle or a fleet of vehicles, machinery, equipment, furniture, fixtures, actual tangible hard assets, building leasehold improvements, etc. These are hard assets that qualify for accelerated depreciation, right? You might have heard terms out there called bonus depreciation or Section 179 depreciation. When you hear those terms, those terms are referring to physical hard assets such as vehicles, machinery, equipment, trailers, trucks, furniture, fixtures, leasehold improvements, etc. And so with those are assets. They're not expenses, right? They're assets, just like a franchise fee is an asset. But these are tangible assets, hard assets that qualify for accelerated depreciation. So you can get a lot of the write-off, in the first year, which is not the case with an intangible asset, which is what an initial franchise fee is. And then all the other startup costs, such as marketing, labor, insurance, professional fees, merchant processing fees, et cetera, dues and subscriptions, like those are all expensed as incurred. And then deduct some things that you're already paying for, right? Home office expenses and vehicles that you've already had that you do use for personal use, but now you're going to use that same vehicle in your business, either like 100% for the business or 50% business, 50% personal, 75% business, 25% personal, et cetera. Expenses that you're already paying on the home office, you can now prorate a portion of them as business write-offs, and then the business use of your vehicle that you already had, before you started the business. Now, a portion of that, either potentially all of it, or if not all, half or a majority of it could potentially be written off as a business expense as well. Bottom left, tax strategies for veterans. Take advantage of veteran business credits, proactive tax planning for year-round benefits. And so, as I mentioned in one of the prior slides, what low-hanging fruit, municipal, county, and state level, are there if a new veteran-owned business, there might be some grants and loans available, to you to look into. And then proactive tax planning for year-round benefits. This should be the normal. This should be the new normal for any sort of relationship between, small business owner and CPA. That relationship, what's implied in that relationship, what's expected in that relationship should be that there should be at least 2, if not 4, touch points throughout the year. And I'm not including the spontaneous stuff that pops up and you have to reach out and this, that, like regardless of when you need something and this, you reach out to your CPA for advice or information request or whatever it is, regardless of that, it's always good to have at least 2 to 4 touch points throughout the year with your CPA firm, talking tax strategy and implementing tax strategy. Because if there's no proactive dialogue throughout the year, then chances are money's being left on the table in the context of overpaid taxes that you could have saved if you planned properly. And you can only plan properly if you're talking regularly with some sort of cadence with your tax professional. And the burden is on the tax professional, right, to have that sort of process. And so like at Reader CPA Group, with our small business owner clients, we make sure that if you're reaching out to us regarding various things throughout the year, whether you're reaching out to us or not, we're going to make sure that we're at least touching base with you, depending on the engagement letter, at least twice a year, if not more, right? Like twice or quarterly are at like the minimums, right? And so just to make sure that we're keeping our finger on the pulse with proactive tax planning, talking strategy and executing strategy, because that's where the magic happens. Effective tax management, that second bullet point where they collaborate with the CPA for optimal tax outcomes is essentially what I just said with, in regards to proactive tax planning for year-round benefits, but maintain accurate financial records. So like right out the gate. So depending on your the franchisor that you become a part of as a franchisee, you will, some franchisors may require to use their bookkeeping vendor that you're required to work with. So whether that's the case, or you can work with a bookkeeper at your discretion, or you're going to have either you or your spouse or someone internal is going to do the books. Take your bookkeeping seriously from day one, because it's just something that must be done. Only positive things can come out of it. If you have accurate, updated books from day one. Because if you are trying to run a business and you don't know your numbers, you're always going to be, playing behind the 8 ball, always behind. It's going to bottleneck the tax preparation process during tax time. It's going to prevent you from having a substantive conversation about tax planning because you don't know your numbers. It's also going to not allow you to have a substantive conversation about, it's not going to allow you to review financial information and make business decisions, related to cash flow and profitability, because you're just, you don't know what your numbers are. You're just looking at you're just reacting to what amount of cash is in your bank account each day, and then it's going to bottleneck any sort of, you're trying to get funding for like a mortgage, like any sort of like mortgage on a primary residence or refinance, any sort of investment property or a business loan, all that type of stuff. Any loan application that you're going through and you're self-employed, the lender's going to want to see financials. And if you don't have financials, it's just going to always bottleneck everything. So for all of the reasons mentioned, it's vital to take to maintain accurate financial records, right? AKA having a solid bookkeeping internal control for your business from day one. And so avoid common pitfalls, stay compliant with payroll and employment taxes, right? So if you have employees, having a payroll processing platform such as ADP, Gusto, Paychex, Paylocity, et cetera, maybe some local payroll processing vendor that you work with that just have you could DIY payroll and QuickBooks. Maybe some of you are familiar with that, some of you are not. But I'm a fan of the third-party payroll processing companies because everything's just done electronically. Taxes and net checks always get paid electronically whenever you process payroll. Taxes always get paid to the government whenever you process payroll. Quarterly and annual reports are always electronically filed as soon as they're due. Payroll processing fees, so you stay in compliance with payroll and employment taxes, vital. You don't want to be bumbling and stumbling with unfiled payroll tax reports, et cetera, when you need to focus on more important things such as sales and operations. And then understanding state and local sales tax obligations. So sales tax depends on the industry that you're in and what state you're in, right? Sales tax differs by state. And so some states, pretty much like sales tax mostly applies to products. Some states also tax service. Some states tax some type of service and not other services. And so state and local sales tax obligations always, that's something that, we can, help you with, we can help you with all this stuff. But sales tax is different than income tax. So sometimes like taxes, like the word, just even the term taxes gets thrown around loosely a lot, right? There's income taxes, there's sales taxes, there's payroll taxes, there's state and local taxes, right? And so there's different types of taxes, so just be aware of all the different taxes that are at play when you're a business owner. The tax code is written for the self-employed more than it is for just the government employee or the corporate employee. With that being said, being self-employed, while the tax code is written for this, while it favors and benefits the self-employed more than it does the non-self-employed, it comes with the burden of, understanding, like it comes with the burden of record keeping, right? It comes with the burden of bookkeeping. It comes with the burden of like knowing what your different tax obligations are at the federal, state, county, et cetera level, municipal level. And so it takes a little bit, it's a learning curve, but then once you implement systems, and then you work with a solid CPA firm, you've got your bookkeeping in place, your payroll in place, everything's in place, then you can go and make money, and you can save a lot of taxes as a self-employed versus being non-self-employed. With that being said, the burden is on you as the self-employed to understand all these obligations, which is what we're talking about. John Trujillo asks, do you recommend using any software in particular for bookkeeping? So I'm a big fan of QuickBooks Online. So it's the Intuit. So Intuit is the parent company of QuickBooks. There's QuickBooks Online and there's QuickBooks Desktop. I'm a big fan of QuickBooks Online. Much more user-friendly. It can sync with your CRM, your POS system, depending on what business you're in. It can connect with your business bank account, your business credit card accounts, your business payroll processing platform. And so QuickBooks Online, you can give it's cloud-based. You can give your accountants access to the QBO. So very big fans of QuickBooks Online. And then once you become and then for any of you empire builders here, right, that want to grow a big business and multi-unit franchisee, and then at some point the books will become, if you ever outgrow QuickBooks due to the nature, the size of your organization, then go into something. The evolution of bookkeeping usually goes from QuickBooks Online to NetSuite, which is an Oracle product. And so, but that's way cart before the horse. QuickBooks Online, QBO as it's referred to, QuickBooks Online is the bookkeeping system that I recommend, is the bookkeeping platform that I recommend that you use.
Thank you.
Of course. So unit economics. So all of the, so let's start with, you're mainly going to see this unit economics as you're going through the business buying process right now, the franchise investigation, franchise investment process. Whether you're going SBA or not, going through the exercise of building projections is going to get an idea of how long it's going to take to go from day one to break even, to ramp up from day one to break even, and break even to certain profitability benchmarks of X, Y, and Z. And so in building out the projections, projections primarily refer to income, revenue and expenses, right? Income statement. Another term for income statement is P&L statement, right? Profit and loss statement. So just like I was saying in one of the prior slides, that the terms funding and financing are two different ways of saying the same thing. Income statement and P&L statement are two different ways of saying the same thing. They're referring to the income statement, which shows your sales minus your expenses equals your profit, right? And so when you start, you're going to have more expenses than sales. So you're going to start out with sales minus expenses equals a loss, right? And then you're going to go from loss to break even to profitability. And then so just as you build out your projections, and you'll be required to build out projections if you're going for an SBA. And if you're not doing SBA, you'd still may be interested in building out projections so you can have an idea of how long it's going to take for you to recover your investment. Everything that goes into projections, you always want to start with the item 19, right? The item 19 of the FDD, and all item 19s are not created equal, but item 19 is the item within the franchise disclosure document that has financial statistics of existing franchisees within the system. And you have to be careful when reading it because there might be giving statistics on some affiliates, right, which are corporate-owned locations that are not franchisees. And so you want to make sure that, you know, you're looking at franchise, you know, so you need to get your, when building out your projections, which, and then within your projections, like your projections can help you determine, you know, your break-even analysis, and, you know, can help you with various benchmarking, you know, like, you know, with various metrics that you're looking for within the overall projections. You need to start out with your revenue assumptions. You know, you so like how do you? It's like what can you put in your projections when it comes to what can you expect in terms of revenue in the first year? So item 19 is a good place to start for that. And so Rich E asked, what are the current SBA loan rates? They're constantly changing, Rich, but it's somewhere around, it's variable. It's somewhere around, I would say somewhere around 10%, between 9 and 11%. Is that accurate, Doug? Kind of ballpark?
Yeah, it's usually the prime rate plus like 2 3/4. So right around in that, I think prime's around 7.5, 7.5. So right around 10 is about average right now.
Yeah. Yeah, that sounds right. Thank you, Doug.
Sure.
And so Rich, you know, we can get it. It's actually, it sounds scary at first, and you know, and we can actually unpack that because you know, Rich says yikes. His response is yikes, as he puts there, and so that is the initial reaction a lot of the times. But this is actually a topic that I dive deep into. That I call, like, you know, it's part of like getting into the business owner mindset and stuff like that. So whether we do it on a breakout call, Rich, or on a one-to-one, let's talk about that. You know, everyone, let's talk about that on our one-to-ones, because it's when you go into business, like interest, you know, like how you view interest rates. I have my spiel on that. But when it comes to you know, so you're putting together some projections from which you're going to determine break-even analysis. You know, projections are pretty much like a projected P&L statement, all right? And then, like, you know, you're also going to use the projections to look at various different benchmarking items. So where do you start? You start with revenue assumptions. Where do you start with revenue assumptions? Item 19 of the FDD, right? And you got to start somewhere, right? Validation calls with existing franchisees. Item 19, right? You have your revenue assumptions. Then from revenue, you can start to plug and play some of the other numbers, right? You know, because royalty is a percentage of revenue. Ad spend tends, at least the national ad spend tends to be a percentage of revenue, right? Like depending on what industry you're in, you might have an idea that, you know, it's expected that your labor costs are going to be a percentage of revenue. You know, your material costs are going to be a percentage of revenue. And then, you know, and then there are some geographical, you know, depending on like where you are in the country will determine, you know, what you can expect, like your, you know, the going rate for certain labor, you know, what you can expect the fair rental value per square foot on occupancy space that you have to rent out. So building out your projections isn't, when I say, when you're building out projections, you want to put your investigative journalist hat on, and you want to go to the sources to build your projections as best as you can. Your sources are the FDD, primarily the item 19. Obviously, the item 7 will have a lot of the startup expenditures, right? And then the item 19 will have a lot of, you know, certain inputs when you're building out like revenue assumptions and, you know, certain profit margins on like cost of goods sold, et cetera, et cetera. So FDD, item 7 and item 19 primarily, and existing validation calls with existing franchisees, and then internet research, you know, Google searches, ChatGPT researches on things that, you know, like that you can expect in terms of like fair rental value square foot in Phoenix is going to be different than fair rental per square foot in New York City. And so just, you know, and then like, you know, what's the minimum wage in this state versus that state. And so all of that stuff, you know, you can find online with some research. And I highly recommend ChatGPT. I'm sure most of us are already using it, but it's one of those things that if you're not using AI as a tool in 2025, then start to, because the world is only going more and more towards that in real time. And so that, like, I'm a big advocate of like I ChatGPT. My internet research is more me ChatGPTing things than it is Googling things, you know, over the last 6 months more than ever before. And then so Rich, It's all good because I'm just done with unit economics. And so before we segue to the next slide, Rich says, what should I plan on as the length term of an SBA loan or any other business loan for that matter? So SBA loan for the most part are 10-year amortizations. And I think it can vary, right? And then, Doug might have some insight into this as well. We know, like, we have our SBA vendors that we work with, Vetrepreneur and Reader, work with the same ones. There's the 7A program, there's the 504 program. 504 is real estate, 7A is working capital for the most part. And then, there's resale versus startup, there's debt refinance, there's different types of loans. But I would say that 10 years is the normal term. Is that a fair statement, Doug?
Yeah, absolutely.
Okay. And then at the end of the day, and there's no prepayment penalties, Rich. There's no prepayment penalties. And so what I do with anyone that I talk to, when we're talking about entity structure strategy and funding strategy, coming at those things from the angle of strategic tax planning and cash flow optimization, I always will ask I will always get clarity on 3 buckets first before I start, going off and advising. What's your investment level, initial plus the first 12 months? Like, is this going to be like a $200,000 investment, a $500,000, a $150,000? Is it going to be work from home, build out? So what's the total investment level? Initial plus the first 12 months, all in. What's the investment level? Bucket number 1. Bucket number 2, what are your assets on your personal financial statement? I want to get clarity on cash, other liquidity, retirement, and real estate. And then what's your household income situation looking like? Are you currently working? Did you recently get laid off? How much are your VA benefits monthly? Any taxable military pension, any other, rental income, any other pension, any other self-employed income, any interest, dividend, capital gain, what's the income? Once we have clarity on investment, assets, and income, those 3 things are attached at the hip, and then that allows me to advise you on optimal entity structure and funding strategy, coming at it from the angle of strategic tax planning, and all that dovetails into, like, if you go a leverage strategy with an SBA and the interest rate is this, but then what about leverage, taking advantage of the third-party debt, preserving your nest egg while your nest egg continues to earn a return in the market, like all of these things, we dive deep into all of these things, get full clarity on everything. I may talk to Rich, and I may, based off of Rich's, 3 buckets, I might say, hey, Rich, go, like, based off of your assets, investment, and income, I suggest that you go LLC with an SBA loan, and here's why, right? And then I'll say to John or to Tamara, hey, after getting context on your investments, assets, and income, I think you should go a Rob C corporation, which just purely Rob C, or just do the whole thing Robs, or do Robs with an SBA loan, and here's why. But that, the whole advice and the logic behind the advice can only happens after we first get clarity on your 3 buckets, because everyone's 3 bucket profile is different than the other. So I hope that's helpful. And
Michael.
yeah, go ahead, Doug. This is all you. Take us home.
No. I was gonna say, I know we saw the yikes from Rich, but I was gonna ask, could you give like a quick summary of how to look at the interest rate from a business owner perspective? Because everybody has that question, and that is a very common, obstacle and hurdle.
Yes. So 2 things that I like, that I'm a big proponent of when it comes to business owner mindset, because I'm a business owner and I advise, both new and existing business owners, just all day, every day for the last 14 and a half years. 2 of my favorite sayings are strategic use of good debt, right? And then also, I'm a fan of using other people's money and while preserving my nest egg, other people in the context of banks and SBA, right? And then for that matter, also, and whatever low-hanging fruits available at the municipal, county, and state level, like I mentioned, for loans and grants. So with all that being said, strategic use of good debt. The SBA loan the loan principal, you're taking on an SBA loan for $300,000 and it's at 10% and it's a 10-year, got no, so on year one, the first 12 months, the interest, like whatever the dollar equivalent is of the 10% based off of this, is that you're going to pay this dollar amount in interest. Your interest expense is going to be X amount of dollars in the first year, but all of that's going to be a tax write-off. So for every dollar in interest that you spend, you're writing off, depending on your tax bracket, depending on what state you're in, for every dollar in interest, it's saving you about, 25 to 33% in taxes, right? So really, so if you look at it from that lens, the interest expense is really, it's really only 2/3 or 75% of like what it really is when you take tax savings into consideration. Further, if you're going to leverage third-party debt, such as SBA, for 80%, for 80 or 90% of the investment, and then in doing so, you're only putting, 10% of your equity at play instead of 100%, right? And that means that the other 90 to 80% that you would have otherwise put into the business is still over here. It's still in your retirement account. It's still in your non-retirement brokerage account. It's still over here. Your home equity is still preserved, and so and so there's more, so that asset continues to grow over here while you ramp up your business, and so that growth over here in the portfolio also has to be taken into consideration when determining the true cost of going the SBA route, because yes, it has an interest rate, but the interest rate has, it's all fully tax deductible, where personal credit card interest is not, right? That's bad debt. Personal credit card interest is bad debt. Mortgage interest on your primary residence, it could be good debt, it could be bad debt, depending on your personal tax situation, if you take itemized deductions or the standard deduction. And so, but the SBA loan interest is good debt because it's all deductible. And then by using it, the assets that you would have otherwise used, they get to continue to earn a return over here. And so these are so when you look at it, so I encourage people, I try to educate people on looking at the interest rate on an SBA loan, for example, holistically, everything that goes into that decision, as opposed to just getting hung up only on what the interest rate is. Is the interest a business expense or a tax credit? The interest is a business expense. It's an expense that's used to reduce taxable income, and then tax is determined based on taxable income. Yes, sir.
Awesome. Good stuff. Thank you. I knew everybody was thinking it.
Yep. I talk about it on every call.
All right. I'll hand it over to Tammy. Thank you, Michael.
Of course.
Thanks, everybody. Just to add one more layer while we're talking about the funding buckets, and Michael, you can, agree, course correct as you need to on this, but I have run into several instances where the client will get to execution of the SBA and not qualify. And a lot of our clients, probably the majority of our clients, will go the SBA route. And what I want to bring to everyone's awareness is that if you have a FICO 2 level 2 credit score of 750, that doesn't mean you're necessarily all in the clear or that you will get a loan approved, because lenders go to a much deeper level, and liquidity is everything to lenders. Now, your net worth, that's important from a franchisor perspective. But from a lending perspective with SBA, they look at 3 really important things. And we have run into this where we've lost, clients that have really had everything in line and couldn't cross the line into the loan. So one is the credit usage. Make sure that credit usage is low when they start looking at these deep dives into getting you approved for an SBA. The second thing is your debt to income ratio. That's really, really important. And then the third thing is post liquidity. Do you have enough to live on for 6 to 9 months post loan, post liquidity? So for your SBA loans, liquidity, cash is king. And just because you have a good credit score doesn't mean you're going to be able to pass that test. And we've run into several clients that have been disappointed. We've learned a lot, but I think it's important for everybody's awareness, like Doug said at the beginning, get that funding and finance in order first. If you want to talk to Michael, when you're narrowed to 1 or 2 or 3 franchises, let's get these conversations going at the beginning so that when Michael presents a good plan to you, if it's SBA, once you start talking to the lenders, now we're going down another hole, and we want y'all to be ready. So we want you to be as clean as possible. And Michael, let me know if I hit the target on that or something other.
No, you hit the nail on the head, Tammy. Thank you. And to just emphasize on one thing that Tammy said, everything was spot on, but the importance of having this entity structure and funding conversation with me sooner than later, before you go down, before you go down the SBA application process rabbit hole with the SBA lender, having the mapping out the strategy with me first, because we'll lay it all out and we'll be ready. Like, we'll make sure that SBA is even something that you can even qualify for. And just we'll lay it all out, and we'll get everything. We'll have the whole strategy laid out, questions addressed, sooner than later, that we can get out in front of if there is going to be a challenge, and we can have a plan B, plan C, etc. All that stuff. The sooner that we actually have the entity structure and funding strategy mapped out, and then you go to the respective lender to execute the strategy.
Thank you so much. That's so important. And we really want everybody to be on a good course once they choose their franchise. Okay. So in terms of sort of turning the page to the business itself and how you prepare to run your business, you may have been a career accountant or a comptroller, and the back office is your baby, and when you have a business, that's where you want to stay. And that would be great. But remember, you also have to be a business builder. And if you hide in the back office, even with a skill that is a core competency, or because you're comfortable there, you may not necessarily grow the business. So I would challenge all of you to prepare to, one, be uncomfortable. Yes, stick to what you're good at, but prepare to be uncomfortable and put yourself in places where others can do those tactical, operational tasks, and you elevate yourself to running that business and building that business. Remember that we talk in our discovery call that you are a manager of resources. You are not an executor of resources when it comes to that. So, however, there's also benefit to hiring people to manage for you, so you can do those other things in terms of getting people who will manage your team of teams. So next slide, please. Okay, so I think Michael has done a thorough job at explaining this slide. I don't know if we need to rehash any of this other than going into our questions now. Doug, is this our quiz time?
Yeah, absolutely. If folks want to go to hit the QR code or go to the Slido to do the quiz, we could try that. Or are you saying to just go to Q&A?
No, this would be great.
Yeah.
We'll know if know if y'all were listening.
They didn't know there was a test. We'll
Right.
see.
Come on, y'all. It'll be fun. It'll only take 30 seconds.
It's anonymous unless you put in the wrong answer, then your name shows up next to it. It's really embarrassing.
Our class clown. So all of the above. So everybody was listening, Michael. Kudos. Doug, good job, guys.
Good.
All right, next question. Which entity structure is required when using the ROBS, Rollover as Business Startup, funding strategy? Whoop, whoop.
Nailed it.
Bingo.
Wow. Smart group.
Yep.
What are the primary ways of funding your business? Cash, retirement funds, real estate, friends and family, robbing a bank. No, that's not in there. All the above.
All the above. Ding, ding, ding.
All right, good job. What is the main difference between a franchise fee and a royalty? Mike explained this very well. Both are monthly payments. Franchise is a one-time. There is no difference. Royalty is a one-time. While the franchise fee is ongoing, there is no difference. Franchise fee is a one-time payment. Royalty is ongoing. Good job.
Awesome. Good job.
Okay, we don't have a lot of time left. We have about 5 minutes. Would you like, we can go ahead and open it up to Q&A here, if that's okay. I think that'd probably be the most efficient use of our time, Doug, if you're okay with that.
Yeah, and it's also good, I think, because Michael can be with the whole
Nice.
group if we're good with that.
So we'll just, I'll give the reins back to Doug, and we can do a quick Q&A to finish up our session here today. Thanks.
Yeah, sounds good. All right. Anybody have anything they were thinking they want to throw out to the group for Mr. Reader? It's got to be something.
Rich is asking where he can find the recording of today's session.
I believe that'll get posted on the vetrepreneur.com portal, and it'll be it actually, when you log in under step 10, it'll say Vetrepreneur Franchise Academy or Vetrepreneur Academy. If you click that, it'll have, that's where the recordings will be once they get loaded in.
Great.
Michael, am I allowed to share your congratulations?
Yes, you are.
So super thankful for Michael coming on today. I'd like to congratulate him to the group as he is a new father, and and I'm sure probably not getting the rest that he's used to getting, but congratulations. So
Thank you, Doug.
Please be kind to him as you're trying to schedule your one-on-ones with him, as we and what'll happen is Tammy and I will connect you at the appropriate point, in the process sooner than later, and do an email intro and connect you with Michael so that, his team can send you the list of available times and you can sign up for that one-on-one consultation with him. But congratulations, and we appreciate you still coming on and doing this for the veterans and the folks that you're helping. So it's much appreciated.
Thank you so much, Doug. I really appreciate it. My wife and I were feeling blessed. This is our second child. So our daughter is 4. So it's nice having the 4-year-old mommy's assistant to help out with the baby. This is our second go around. We have a baby boy now. So just feeling really blessed. So thank you so much.
That's awesome. Congrats.
Thank you so much. I do see it right when we were, some extra questions came in. So Tamara, is there any support for us as we review the FDDs? So Tamara, we can review that. So I, as the CPA, I stick to, reviewing any sort of financial related items on the FDD, such as items 5, 6, 7, and 19 and 21. And we can review those at a high level on our free CPA consultation calls. And then Vetrepreneur has a great affiliate lawyer that they can refer you as well for, the legal side of FDD and franchise agreement review.
So Michael, I know it comes up a couple times where folks will get the FDD and it's got, the audited financials as part of one of the exhibits. Is that something that if somebody's concerned and they would just want to see like the cash position or just see if there would be any ongoing concerns or something that you could help with as well? I know that comes up quite a bit because a lot of folks don't spend a lot of time reading financials.
Yeah, so that's item 21 of the FDD is what Doug is referring to, everyone. And so item 21 of the FDD is the audited financial statements of the franchisor. Now that is mandatory by as per the FTC, whereas item 19, which is financial information of the franchisees in the system, that's discretionary. The franchisor can choose to have a robust item 19 or nothing or something in the middle, but every franchisor must disclose the audited financial statements of the actual franchisor entity itself, and there's no, discretionary. There's no discretion there, and so yeah, so anyone that wants, and that is something that if you ask the attorney, they'll punt it to the CPA. And so that is something that, I can review with you on the free CPA consultation calls.
Awesome. Thank you.
Absolutely. And then let's see.
Are there any other questions?
Yeah.
I think we're good. I don't think there's any other questions. And I know that I know you have meetings coming up, Michael, so I'm going to be respectful of time because I just had somebody from another class tell me that we're going to have to reschedule ours because they scheduled yours over top of mine, and you took precedence. So I'm going to be respectful of that. So have a good call coming up. But
thank you, Doug. Yeah, I got something coming up at the 2:15. So if there's anything that pops in, I'm here. But yeah, I got another call in 14 minutes, and I look forward to. I always look forward to these, to these group sessions, and I look forward to getting a one-on-one with any of you that I haven't spoken to yet, and for anyone that I already have spoken to, we can always do another one as well. So thank you once again, Doug and Tammy, for putting this on, and Edgar, everyone here. I'm here for you. Have a great weekend, and we'll be in touch.
sounds good, Michael. Awesome. Thank you as always. Thanks everybody.
My pleasure.
We're a little bit over, but it was great stuff, and we'll talk to you all soon.